let's talk about the difference between stocks and bonds. So if we look at stocks, stocks are ownership. This means that you as a stockholder, as someone who owns stock in a company, owns a little bit of the company. You own a little bit of the plant, property, and equipment. You own all the assets. You also have all of the liabilities. You also have a claim on the future cash flow or profits of the company. However, you also have a risk that the company could lose money and therefore the value of your investment goes down. So stocks are the claim on the future value of the business, is a way to look at it. They're often called equity. So a term that's often used is the equity markets. Equity is the same as stocks. So when you think of somebody saying, well, we invested in equities, what they mean is a different name for stock. You have equity, which is ownership in the company, which is synonymous with owning stocks. Now, stocks you can profit from stocks in two ways: dividends and growth. So if you have profit from the stock that you own, the company has profit, then they can do two things with that profit. One, they can reinvest it in the company. So an example of that would be, say, a chain of stores, restaurants, etc., where they have maybe 200 stores and they want to go to 1,000 stores. Well, they're not going to pay off their profits and dividends and give them back to the owners. They're going to take that money and reinvest it to grow the company and have more stores. So that would be an example of how the company takes the profits that are claimed or could be claimed by the owners and reinvests them to grow the company. Another way, of course, is dividends. Now, dividends are owners' profits that the company pays to owners directly in the form of a check. You get a dividend check. And so those companies are not reinvesting all their money into maintaining or growing the company. They are throwing off cash in the form of profits, and they hand them off to owners in the form of dividends. So you can grow your position in stocks. You can profit from either growth or through dividends that are direct payments to you. Of course, you have to reinvest the dividends, and the growth is the company is a reinvestment for you. Now, of course, you can lose. And you can lose in a stock because the company's prospects aren't certain. We don't know if the restaurant going from 200 restaurants to 1,000 will pay off. They could be taking a huge risk in borrowing lots of money as well as reinvesting all their profits, and they could move into an area that doesn't like that particular style of restaurant, or they could have a crisis where they have some sort of product problem, etc. So you are taking the risk. The ownership is a claim on the profits, but you also can lose. The company could completely go bankrupt. Now, if you're buying public companies through the stock market, the maximum you can lose is everything, or 100%, or go down to zero. So if you invest into a company that goes completely bankrupt, you can lose all your money, but you can't lose more than that. If you start your own business and put your house up as collateral, you can lose your house. So if you think of stocks as the possibility of 100% loss is your max. You can go to zero, but the profits are unlimited. The profits can be, you can start with a small company with two guys in their garage like Apple did and grow it into a huge company. So you can make, it's unlimited. So stocks are somewhat risky in that you have both a gain and a loss, and they come from the future growth of the company, the future profits and success of the company. Bonds are loans, and they are the debt market. So this is equity versus debt, ownership versus loans or borrowing. So the company or the government or whoever has the bond is basically, if you buy a bond from them, they're asking you to loan them money, and in return for that money, they pay you interest plus principal. So your interest plus principal is what you're getting back for your lending them money. So interest is paid over the term of the loan, say a 10-year loan at 10%. They would pay you 10% per year, and at the end, they would pay you your last interest payment and then give you your money back. which is the principal, which you get at the end, and you would maximize your gains in holding the bond for the whole time. If you held it for the whole time, you'd maximize your gains as a total of the interest payments plus getting back your principal. However, of course, bonds can be sold before that. We'll talk about that in a different session. But if you sell it before, you can win or lose on the bond by trading it. But we're going to say you hold it to maturity at this time. So bonds are loans, they're debt, they pay interest to you, and you get a return on your principal. Now, that's how you gain on a bond. How you lose on a bond is if the company goes bankrupt and doesn't return your principal any longer. So there is no guarantee that when you loan somebody money that they won't default or they won't have a problem in which they can't pay you anymore. Therefore, bonds are not risk-free. They are capped at the maximum you can make, which is the interest plus the principal. And although you can trade bonds and make more than that, but we're talking about just holding a bond at this point. And so bonds have a limited upside, but they also have a limited downside in that if you don't get your principal back, no one on the equity side gets their principal back either. So the order of payment here is crucial. The equity or the ownership, the stock has to be wiped out before the bonds are wiped out. So if you have assets, say you have buildings like restaurants, and you own the ground and the land and the property, and that can be sold off, that can often pay the principal back to the bondholders, even though the cash flow and the business itself has gone bankrupt and the ownership, the equity holders, have lost everything. So bonds are safer than stocks because they get paid before stocks get paid in the case of a delinquency, but because they're safer, they also have a less of an upside, and they have no share of the profits. The profits of the company do not acquire to bondholders. They don't get any upside. If the company does really, really well, the most they're going to give you is your interest payment and your principal back. They're never going to give you a cut of the profits. The ownership, the equity side, gets a cut of the profits. So if you loan the company money and they do really well, that's good for them, but you only get your interest back. If you're an owner and the company borrows money from the bondholders as well as taking your money as equity holders, then the company can grow and the shareholders, the stock owners, the equity side can win, and then the bondholders get paid back their money. But if the company loses, if they've bought things that can be sold later in assets, or they still have some assets, but they're bankrupt, basically they are going to default, then all the shareholders get wiped out and the bondholders get whatever's left. So think about stocks versus bonds in terms of ownership and profits and losses of the company, and loans to the company or loans to whoever else as debt. You're loaning them money. So the difference between a stock and a bond is basically the ownership and loaning someone money.